Thank you for watching this preview video at xm.com. We'll be discussing the upcoming U.S. jobs data and the outlook for the dollar. I'm Maria Pachurdes, and joining me is Senior Investment Analyst Harlan Vos-Pisuros. So Harlan Vos, the U.S. economy seems to be more resilient than other major economies at the moment. At the Fed's latest gathering, policymakers raised their rate path projections. Has the data that has come out since then confirmed the higher for longer view? And what can we expect from Friday's employment report for September?
Hello, Maria. Yes, since the latest gathering, US data continued coming on the bright side, with the latest examples being Monday's better than expected ISM manufacturing PMI and yesterday's upbeat JOLTS job openings. Now, with regards to Friday's jobs data, non-farm payrolls are expected to have slightly slowed to 163,000 from 187,000, but the unemployment rate is forecast to have ticked back down to 3.7% from 3.8%, which is supported by the modest decline in the 4-week moving average of initial jobless claims. However, I believe that wage growth may attract special attention as well, as it may provide a glimpse of where inflation may be headed in the months to come. So, average hourly earnings are expected to have slightly accelerated in monthly terms, keeping the year-over-year rate steady at 4.3%. Now, this, combined with the uptrend in oil prices, as well as the rebound in headline inflation, and projections that the US economy likely performed better in the third quarter than in the second one, may add to the risk of underlying price pressures intensifying in the months to come.
Turning to the dollar now, how can we expect the greenback to perform after the data?
In my opinion, the initial reaction in the dollar may come from any surprises in the non-farm payrolls or the unemployment rate. However, whether this will be a lasting one could depend on wage growth, which, as I already mentioned, could raise speculation of stickier than previously expected inflation. Now, with investors still projecting a lower rate path than the Fed, assigning only a 50% probability for another hike and expecting rates to end 2024 at 4.7%, I believe that there is room for upside adjustment should Friday's data come in on the strong side, and this is likely to push yields higher and thereby encourage traders to buy more dollars. What's more, expectations about the Fed's future course of action are not the only driver behind the dollar. There is also a strong note of uncertainty due to the economic challenges facing China, Eurozone, and the UK, and with no other alternative, the only place to seek safety seems to be the US dollar. In other words, it's the safe haven of choice, as the yen has long lost its safe haven status due to the Bank of Japan maintaining a lead on Japanese government bond yields at a time when US rates are keep rising, while gold has fallen victim to both surging yields and a strong dollar, and has lost nearly 6% of its value since September 25th.
Harlan Vos, thanks so much. This was a preview video here at xm.com.